Okay, let's dive right into this explainer. Right now, we're literally watching a massive institutional shift happen across the entire financial landscape, and it's all anchored by a very real, very fast approaching deadline. If you follow the markets, you already know that tectonic plates of traditional finance and digital assets are kind of grinding together. But what's wild is how rapidly the timeline for all this is accelerating. Today, we're going to analyze exactly why a piece of legislation known as the Clarity Act matters so much to the market's biggest players, and why the window to act is closing way faster than people think.
So, the clock is aggressively ticking down. We've got roughly 30 days left until the August 7th Senate summer recess. And you guys, this 30-day window, it is absolute crunch time for the Clarity Act. This isn't just some minor administrative bill, it's the foundational framework the whole industry has been holding its breath for. Lawmakers are feeling the heat, because once that recess hits, legislative momentum just stalls out. The crazy urgency we're seeing right now, with industry leaders making a full-force push to Congress and the White House, is entirely driven by this August 7th cutoff.
Let's move into Section 1, the institutional Bitcoin shift. To really grasp the scale of this shift, while everyone's sweating this legislative deadline, you just have to look at VanEck. We're talking about one of the largest financial institutions on the planet, managing a massive client base worth $200 billion. That is a lot of capital. Recently, they made a hugely strategic move. For the very first time as an institution, they bought the Bitcoin dip when the price hit $60,000. Think about that. When a $200 billion TradFi giant goes from just watching an asset class to actively buying a dip for its own books, that sends a profound signal to the rest of the market that the paradigm has absolutely shifted. And they aren't just doing this quietly in the background. They're giving very specific instructions to their clients. Matthew Siegel, who heads up digital asset research over at VanEck, is actively telling their client base to get their full Bitcoin and crypto positions ready and fully allocated by October. He's advising what's called a time-based buying strategy, just adding a few basis points to your position every month to cost average into the market as we head into the fourth quarter. They're looking at the calendar, they're tracking those historical 4-year market cycles, and essentially drawing a hard line in the sand at October for when portfolios need to be locked in for whatever comes next.
Now let's look at the underlying derivatives data driving this strategy, because it's super interesting. Institutions aren't just blindly buying every single dip. They are being incredibly picky. When the price hit 60K, VanEck's team looked at the data and saw intense bearishness, but crucially, no total capitulation. Notice the specific metrics here. The premiums people are paying for put options versus call options are in the 80th percentile historically. That means puts are super expensive because folks are hedging hard against a crash. At the same time, realized losses are sitting in the 90th percentile, meaning traders are actively dumping out a loss. But, catch this, the older cohorts, the people holding for 2 years or more, have significantly slowed down their selling. Combine all that and it paints a picture of what analysts call seller exhaustion. Sellers are running out of steam. But since total panic capitulation hasn't quite hit, institutions are playing it safe with that cautious cost-averaging approach, instead of just going all in.
Which leads us to Section 2, waiting for a catalyst. This brings up a really fascinating bit of market psychology. Why are these massive funds being so cautious and methodical in the short term, even when their own analysts predict values will be materially higher in a year? Well, it's because institutions just don't operate like individual retail investors. They don't have FOMO. They are perfectly fine missing the first 10 to 20% of a massive market rally. They'll gladly sacrifice that early upside if it means waiting for a fundamentally positive piece of news to act as a definitive catalyst. They want absolute fundamental certainty before they enter the market. So in the meantime, they just use that time-based cost-averaging strategy to safely build a foundational position while they wait for the dominoes to fall.
And what exactly are those dominoes? Well, they're waiting on a few major potential catalysts coming down the pipe. First, you've got all this chatter about the White House teasing a strategic Bitcoin reserve, which is a narrative that's really been bubbling up under the surface. Second, there's the continual growth of sovereign wealth adoption, which acts as a massive baseline for the asset. But the big one, the one culminating above all of this, is the most pressing and immediate trigger: regulatory clarity from the United States government. And that is encapsulated entirely by the Clarity Act.
All right, Section 3, inside the Clarity Act.
So, this is the crucial part. Why does the Clarity Act matter so much to these $200 billion institutions? What does it actually aim to do? To get it, we have to look at the timeline of financial innovation. Former New York Governor Andrew Cuomo brought this up recently, and he pointed out a stark historical reality. Normally, when the market innovates, like moving to electronic trading or credit default swaps, the government lags about 9 to 10 years in writing the rules for what the market has already done. 10 years is a long time, but hey, the government isn't exactly famous for blistering speed, right? But here's the thing. Crypto took off in 2009. We are way past that typical 10-year window. This has been an extraordinarily long time for an industry of this magnitude to operate without defined legislative rules. And that's exactly why there's such a massive push for the Clarity Act right now.
Because the argument for the underlying tech is rock solid. This technology inherently promises to revolutionize the financial system for the better. It's faster, it's more efficient, it gives you 24/7 market access, and ultimately it is deemed better for the consumer and the broader economy. Traditional finance systems might fight it, but history tells us you literally can't put technological advancements back in the box. Just like the old ticker tape inevitably got replaced by electronic trading, this next phase is bound to happen. The market desperately wants to adopt these benefits, but it's currently paralyzed by a lack of operational guidelines.
Which brilliantly illustrates the neutral reality on the ground right now. Cuomo really highlights what these major companies are actually saying behind closed doors. They're not asking for special favors or sneaky loopholes. They're simply saying, I need a referee. Just tell me where the lines are on the field and what I can do and what I can't do. Institutions like VanEck want to play the game. They want to offer these products to their clients, but they need to know they aren't going to accidentally step out of bounds simply because the boundary lines were never painted on the field in the first place. That is what the Clarity Act provides, the lines on the field.
Moving to Section 4, the global crypto race.
This lack of a referee in the U.S. doesn't just hurt domestic companies. It has sparked a highly competitive global race, which makes that August 7th deadline even more critical. Because while the U.S. sits around debating the rules, the rest of the world is just moving forward. Globally, sovereign wealth adoption is a continual, accelerating story. Right now, there are 22 countries actively mining or holding Bitcoin at the sovereign level. And that number is not stuck. Data shows it's ticking up by about 1 or 2 new countries every single year. That's a massive geopolitical and economic shift. If that trend unexpectedly reversed, sure, institutional investors would have to reevaluate, but right now, the global momentum is clearly moving in one direction.
And this creates a glaring international discrepancy. When you compare the frantic legislative scramble in the United States, where they're just trying to push the Clarity Act before August to get basic definitions, to what's happening over in Europe, the contrast is absolutely stark. Europe has already successfully pushed forward, passed, and implemented comprehensive regulatory frameworks like ESMA and MiCA. They have painted the lines on their field. They've created a safe, regulated environment that's good for their industry and good for their consumers. The U.S. is lagging significantly behind the standard right now, and it's creating a very real risk that capital and innovation will just flee to jurisdictions where the rules are already clear. And that is exactly why we're seeing such a bipartisan sense of urgency. Republican Senator Cynthia Lummis summed up the stakes perfectly. She stated, "It's a decision about whether America leads the next financial system or watches from the sidelines." She views the Clarity Act not just as some crypto bill, but as a defining moment for America's economic future. It's literally a choice. Do we take the mantle and lead this next iteration of global finance, or are we okay sitting back and watching regions like Europe and those 22 sovereign nations take the reins? As we watch $200 billion institutions meticulously gear up their portfolios for a full allocation by October, banking on fundamental catalysts and seller exhaustion, the tension is just palpable. The industry is completely ready, the technology is inevitable, and the rest of the world is already moving. So the ultimate question I want you to take away from this explainer is this. With that August 7th deadline rushing toward us, will the U.S. government finally step onto the field and set the rules before the clock runs out? Or will America truly be left watching the future of finance from the sidelines?